I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today we're bringing a topic, a loan program, and this is an alternative to hard money.
DSCR. Boy, those acronyms don't get any easier than that, do
That's
they?
right. Debt Service Coverage Ratio. That's the loan we're going to be talking about today. Just a reminder to everyone before we get going, this is for informational purposes only. This is not financial advice. And also be sure to subscribe, click the like button, and comment below. If you have anything to say, we'll be happy to get back to you.
Awesome. Let's get going.
All right. So best alternative. What is hard money? I mean, like, a lot of you have heard of it. Maybe a lot of you have watching have actually had a hard money loan. The pros and cons, where let's go right into it. The first pro that I put on the list here is the quick closings. It's all about timing with the hard money. Very little underwriting is needed. You can close as soon as possible. I mean, really, you can close probably in 5 to 7 days.
Yeah.
Maybe 3 days, but
yeah. I mean, and they call it hard for a reason. I mean, they can do things very, very quickly, but also their underwriting. I mean, it's like they have certain standards and it's hard. And it's boom, 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 boom. They get paid, they get their interest rate, they get their money, and they move on. So that's the hard bit.
That's right.
Sounds easy, but it's actually a little bit hard.
All right. So they can quit. On hard money can be quick. And that's what's great about them. Now, the cons is they have high interest rates, typically 12% or more. They have high fees. Typically, they have several points associated with them, and they require lots of equity in your home. All right. Sometimes maybe you can find a hard money lender with 20% down minimum. Sometimes it's 40%, sometimes 50%. These are the loans that are not good for longer term investors.
Yeah. And these hard money loans, I mean, they are for those people, they're typically more savvy. Again, they need to move quick. And though they are expensive, they usually fill a need. There's an opportunity out there. There's a priced property that they need to go in and close on. And it's like, we don't really care what we're paying. We just need it for a month or two, and we've gotten calls over the years saying, hey, do you have any hard money loans? And, lately we've been saying, no, COVID changed a lot of that. But the reason for this podcast is we have a better alternative now to these hard money loans.
So this DSCR loan, what is the debt service coverage ratio? And there might be other names for it. I know that in the commercial world, right, Tom? And there's different, like, commercial banks would have a loan like this. Like if you're used to
it would be the only loan. They would almost say, we don't care about what you make personally. We just want to know, what is this property producing, and is it going to pay the debt service?
Yeah, so this really probably comes from the commercial world of lending, where what is the debt service coverage ratio? It is taking the gross rent income divided by the principal, interest, taxes, and insurance payment. Mm-hmm. And we have this example right up here. Let's say that the rent that you can get is $2,500 on a month on the property, but the mortgage payment is $3,000. That's the principal, interest, taxes, and insurance.
Mm-hmm.
That creates that ratio. $2,500 divided by $3,000 is 0.83%. And this program requires that ratio to be over 0.75. So in this scenario, which is very normal, or typical right now in Arizona, in our markets here in Maricopa County, this is very normal.
Yeah. And this is our alternative to hard money. And what you need to be thinking is, when you call in, this is a program where we're basically allowing you to get 100% credit for your rent. The typical person that comes to us for the underwriting, we talk about this 75% of, rental rate analysis. So this is a little bit different, 0.75%. And hopefully that didn't confuse people, but basically you come to us. We don't care about any of your personal income, no bank statements, things like that. We literally just ask you, what is your rent? And we can give you 100% credit for that rent. And it doesn't even need to cover the full PITI.
Right. Absolutely.
I mean, that's incredible.
Yeah. So I think that's where you're starting to go into the pros and cons, or the pros. So let's just go right through the list here we have for everybody who's watching. And the pros, we're going to have, this is, again, compared to hard money loans. DSCR loans have lower interest rates and lower fees than hard money. Down payments as low as 20%. You use it to purchase a house or cash out refinances. Or let's just say you already have a mortgage on the property. You just want to refinance that mortgage. You can do that on a refinance as well.
Yeah, you could actually already have a hard money loan, even though you can use this instead of a hard money. Even if you have a hard money, you can use this to refi out of, which is huge.
Yeah, I think that a lot of borrowers will probably use it that way. Maybe the hard money is just used to buy it from like a foreclosure, court steps, and we're using this loan to refinance that. So if you did buy something using hard money, you want to get out of that thing right away. This is a good loan for you. So bank will give you 100% credit, as Tom was saying, for your rent. And here's the good stuff here. There's no lease is needed.
Holy no
We
lease.
no lease. We use the market rent from the appraisal. There's no personal income needed. We don't need their tax returns. We don't need your pay stubs. We don't need your employment.
No, how do we know that it's actually going to be leased?
When we order the appraisal, we order a credit market analysis where the appraiser looks around at the comparable sales, comparable rental properties, and sees what their rental is or what their rents are going for.
So you don't even need a signed lease. I mean, that's awesome. So you look out your window, you see a property for sale, your neighbor's selling it, you know it's a good deal. You want a better rate than what hard money can provide, and you don't even need a lease. Right. You can go in and basically say, let's have the appraiser tell us what the rental rate is going to be. And as long as that's 0.75 of the actual PITI, done.
Exactly.
Wow.
So gifts are allowed for down payments, but there's certain terms.
Big deal. Yeah, gifts. I mean, normally gifts on investment properties are a huge no-no. Right. Huge no-no. So this is one of the areas where it's actually better than a conforming Fannie Freddie loan.
Yeah, it's true. Loan amounts, we can go up to $3.5 million. So again, this can be an investment property or just you're buying a house. It can be high end. You can buy something up in Paradise Valley or North Scottsdale, and it's a $2 million home, $3 million home.
I wonder what those will rent for.
That's true.
Holy cow!
Yeah, that's true. The debt ratio is the loan to value may be adjusted just because on the higher you go on the value, usually the lower rents as a ratio. But anyway. Minimum credit scores it is 620. If you're the lower your credit score, the higher the interest rates. So you just want to talk to us about that. And then let's just talk about the cons. This is the opposite of hard money when it comes to like paying it off quick. You want to pay off a hard money loan real quick, but not this loan. You cannot pay it off before 6 months. And then this is only for investment properties. This is not for second homes. It's not for, a cabin up in, Flagstaff or Show Low, Pace, and nothing like that. The home also needs to be in livable condition. It cannot be, hey, it's a great deal and it's gutted.
Right. Can't be in a coming soon condition.
Yeah.
It has to be complete. And I just wanted to make a note about the Flagstaff, Sedona homes. Again, we can do those as long as they are investment. They just can't be a vacation home.
Right. That's true. Right. So in livable condition, again, even if it's old, it's okay if it has old carpet. It's okay if it's an old home.
Ugly carpet's okay. Just has to have carpet.
Yeah, right. So that's what we're looking for this program. And who is the DSCR loan perfect for? That's our next slide here. And really, it's for investors who do not want to provide all that employment information, the tax returns, pay stubs, W-2s, right? That's the big issue there. Okay, so it's also for investors who are looking to buy and flip properties as long as payoffs do not occur before 6 months for the loan closings. So we already touched on that about a minute ago or so, but this is for borrowers who want to be buying that house either for long term or they're going to be doing something to the property, renovating it, and it's going to take longer than 6 months.
Yeah, we call this kind of a midterm loan. And what I would tell people is this is classic for those self-employed borrowers, 1099 borrowers, bank statement, program borrowers who have very complex income. And the good news is, again, we don't need to go there. You could have an attorney who goes from, W-2 to a partner. Hey, congratulations, you're now a partner. But sorry to tell you, you can't get a loan. So this would be one of those loans where you'd come in and this would solve those problems because we wouldn't need the 2-year tax returns. We wouldn't need a certain amount of seasoning for your job. So again, huge thing. I'm just basically going off of the rental income and that's it, not looking anywhere else.
That's right. This is also good for investors who are looking to be buy and hold. I mean, you're going to have to analyze what and we'll help you do that. Like, is a conventional loan best for your long-term plan? It might be, right? And chances are, depending on what your income, and how easy it is to document your income, a Fannie Mae or Freddie Mac loan might be the best.
Mm-hmm.
But this loan may be better for you for buy and hold as well.
Yeah, so I would say that this could refi you out of that hard money loan. And even if it refis you out of that hard money loan, you may be just looking to bridge a certain gap. We can always refinance you into that even lower interest rate Fannie Freddie loan after you get into a situation where you can show income. Yeah. So you can either buy using this, or you could refi into this, but eventually we want to refi you out of this again into a lower rate product.
So something that we didn't have in this list is, as many of you know, if you are investors and you have a lot of properties, you'll know that conventional loans have a limit of 10 finance properties. So maybe you have 11 properties or 12 and you're just not eligible. I mean, you can have 20, you can have a lot. Again, that's something you want to immediately talk to your loan officer about when you call us. But the point is that you may just not even be eligible for any other loan than this type of loan. This is someone, again, this is good for someone who has a lot of properties.
Yep. Yeah, exactly.
All right, everybody. How do you get a hold of the Mortgage Brothers? Well, you can definitely call us here. In the description, you'll see all of our contact information. You can email us as well. You'll see our phone number here. You can Google us, Mortgage Brothers Team. You'll see our reviews. We're here local in Phoenix. We help a lot of borrowers. We're licensed in Arizona. We know this market well, so be sure to contact us.
Hey, thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.